Moving now to U.S. West Stock Index futures, we're under slight pressure ahead of open as investors turn their attention to the latest corporate news while trying to shake off the volatile trading scene in markets worldwide. The movement seen in the U.S. futures come on the back of a slightly negative close on Wednesday in the previous session. U.S. stocks finished in the red as interest rates climbed back towards multi-year highs. For more, here is Jill Malandrino, Global Market Reporter, NASDAQ.
After nearly a year and a half of historically calm markets, volatility made its presence known in the past few trading sessions. We ended Tuesday with a gain of 1.7% in the S&P 500, while the Dow closed at 567 points following the global slide in stocks on Monday. Sure, headlines were sensationalized with the Dow Jones Industrial Average hitting correction territory down over 10% from all-time highs at the market open on Tuesday. But let's dig below the surface and see how market structure held up during heightened volatility, particularly as markets are trading higher in the early Wednesday session. Modern markets are complex. In the last 10 years, we've seen extraordinary technological advances and regulatory changes to the way markets function. Our systems at NASDAQ and across the exchange industry operated as they should through this pocket of volatility, and we continue to maintain fair and orderly markets throughout this activity. NASDAQ halted trading on several ETNs. Now, does that mean things are not operating as expected? No, actually quite the opposite. Halting trade on a security shows that our systems are working properly to protect investors. So what was the catalyst behind the market sell-off? Initially, it was thought that better than expected jobs and manufacturing data increased fears that the Federal Reserve would be more aggressive with interest rate hikes in 2018. But what made the markets drop worse were volatility products and the billions of levered dollars tied to them. The selling pressure uncovered the difficulty of unwinding these heavily crowded trades. Now, pullbacks are never fun to endure, but it's important to remember that they have a normal course of long-term investing. The weakness we saw is against the backdrop of strong economic and corporate data. Fourth quarter earnings have been solid, guidance for 2018 is positive, and that's causing earning projections to accelerate. From the NASDAQ market site in New York, I'm Jill Malandrino, Global Markets Reporter at NASDAQ.
And in Asia, stock indices closed higher today after last session's rally stalled late in the traded day. Gains in the region followed the slightly lower close seen on Wall Street as U.S. bond yield rose. In Tokyo, the Nikkei 225 jumped 1.13% after closing barely in positive territory in the last session. In Seoul, the Kospi closed up 0.46% at 2,407 points after finishing in negative territory on Wednesday. In Australia, the ASX 200 edged up 0.24% to finish the session at 5,890 points as losses in the energy and material sectors were offset by gains in the heavily weighted financial sub-index, which rose 0.75%. Hong Kong's Hang Seng Index rose 0.35%. Indices on the mainland closed mixed after lagging other regional indices in the last session. The Shanghai Composite slid 1.42% to close at 3,262 points, while the Shenzhen Composite rose by 1.18%. And back here in Africa, South African mobile operator MTN Group Limited plans to raise about $500 million from the sale of shares in its Nigerian business during the first half of the year, fulfilling the terms of a deal struck with the West African nation to settle a record fine. Standard Bank Group Limited and Citigroup Incorporated have been advising MTN on the disposal of as much as 30% of the Lagos-based unit on the Nigerian Stock Exchange. Most of the shares will be sold to local institutions and individuals, though foreign investors could be brought in to ensure the process is a success. Discussions are ongoing and a final decision hasn't been made. MTN agreed to list the Nigerian unit as part of a June 2016 agreement to pay a $1 billion fine for missing a deadline to disconnect unregistered subscribers amid a security crackdown. And Kenya has mandated 4 banks, including Citigroup Incorporated and JP Morgan Chase & Co., to manage a sale of Eurobonds planned within the next 2 months. The ministry also chose Standard Chartered Bank PLC and Standard Bank Group's Kenya units Stanbic Holdings to help with the sale. The Treasury will seek to raise $1.5 billion to $3 billion in bonds with a tenure of up to 15 years. Kenya is increasing the amount of funding it raises from foreign sources as the Central Bank of East Africa's biggest economy forecasts an acceleration in growth to 6.2% in 2018. In the meantime, Citigroup expects 2018 to be its best year for investment banking in the Middle East and Africa in at least a decade, likely led by Saudi Arabia. Citigroup said last month it had won formal approval from Saudi Arabia's Capital Market Authority to begin an investment banking business there, enabling its return after an absence of almost 13 years. The bank also expects significant opportunities in Nigeria, which has low debt levels and was expected to return to the bond markets in 2018, while Nigerian companies were also forecast to issue bonds and launch initial public offerings. Zimbabwe is negotiating a $1.5 billion guarantee with Afreximbank to ensure foreign investors' funds are protected. Under new President Emerson Mnangagwa, who rose to power following a de facto military coup that forced Robert Mugabe to resign in November, the government is trying to assure foreign investors that their money is safe in Zimbabwe. Zimbabwe, where Mnangagwa is trying to woo foreign investors, was also arranging a $400 million facility to ensure payments for critical imports and allow investors to repatriate funds. And when we come back after the break, we'll take a look on the global oil market. Just stay with us.